Yo, what's good, beautiful people? Peace, love, and law. Welcome to In God We Trust Academy podcast and Work Session Season 9. We are fully fledged back into routine now. Today is January the 26th, 2026. So again, welcome, beautiful people. We got about 7 more minutes before we get started. Those of you watching from the different platforms, like, share, and subscribe with us today. And make sure that you're following us. We got 10 weeks, 10 volumes to go through. This series is the Lawman Master Merchant Tax Series. So, a lot of information is going to be dropped today for the next 10 weeks. So 10 weeks, guys, except for the fourth Wednesday. We're going to talk a little bit about that. We're going to give you guys some announcements, things like that. We're going to hear from the people, tell you how to get in work sessions if you're lost. And we're going to make sure you get in here with us, all right? Let's do it. All right, so while we waiting, let's give you guys some announcements. First and foremost, In God We Trust Academy, the Lawman Master Merchants Tax Series, Work Session Season 9 is every Monday and Wednesday, except for the fourth Wednesday, okay? And I'll tell you why. But Mondays, 11 a.m. Central Time, Wednesday, 6 p.m. Central Time. It is free. You can join us in work session by registration at admin@ingodwetrustacademy.org. So send us an email, say you want to join work sessions, and we're going to make sure that you get in here, right? So you definitely have to follow the instructions, follow the rules. We'll make sure you're in. If not, you can watch from the platform wherever you're watching from now, to be able to also enjoy the class. So it's free. However, if you want to be able to get the recordings and things like that, you're going to have to go to www.ingodwetrustacademy.com and be able to make those purchases for those things. But as long as you're here in your presence, then hey, you will definitely be able to learn with us as well. So we also got the Lawman series. Now this is going to affect the fourth Wednesday. Now, the Lawman series is beautiful. It's touching so many different subjects. Every subject pretty much matter in law. And everything else that you see, like the tax series we're doing, is under this. So this is going to be dropping. It's a 10-volume series of equity, law, and procedure, and other things as well. February the 6th, 2026. All right, it's going to be a bulk ownership. So if you are a do-it-yourself type of person, you will be able to buy it in bulk that day. Otherwise, there will be monthly live classes every fourth Wednesday, 6 p.m. Central Time, $125 per class. It comes with the actual knowledge instructions and the ebook as well for full premium services for those who like the class setting and things like that. So that'll be up. The first class is Foundations of Law and Procedure. That is Wednesday, February the 25th, 2026. 6 p.m. Central Time. So again, that is the fourth Wednesday. That will be happening for the next 10 months. So every fourth Wednesday for the next 10 months will be going on. Okay? Make sure you understand that. We also got Tender by Performance coming February 21st, 2026 as well. There's 2 tiers for there. So you can go to www.ingodwetrustacademy.com and be able to make and decide whichever tier that you want in there. Tender by Performance, right? Don't forget about Kari Retreats. If you're looking to travel at any given time at this moment, especially trying to get somewhere warm as well, all right? Especially if you're trying to get somewhere warm, text TRIP to 256-263-0771 to get started, or go to KariRetreatsandTeletravel.com. All right, you can do that as well. Stay in touch with us on YouTube, Facebook, Instagram, TikTok, and Twitch, as you see. So do stay in touch. Also, we're still setting up trust. So if you're interested in getting your trust set up by In God We Trust Academy, go to ingodwetrustacademy.com to do that as well. And every Friday night, guys, we're having fun, giving away prizes from bingo. So we have a bingo night every Friday. It's a $10 entry, and it includes one free raffle ticket for you to get a chance to win a free car. 8 p.m. Eastern Time, 7 p.m. Central Time, every Friday night. So if you want to join us, then you can. All right. You definitely can. The tax series work session is not on the website. You're involved in it now. All right. So as you can see, this is today. We got 10 volumes, 10 weeks. All right. And then you got the Lawman series. This is 10 classes that's going to be taking place for 10 months on the 4th Wednesday. So just know that. All right. So we got a lot going on, guys. A lot of things for you to be able to participate in. The Lawman series has a whole lot more to that is going to be coming with it as well. This is the tax series of the Lawman series as well. And so it's going to be a lot. All right. So it's about our time to get started. So we're going to hit that record button. All righty, family. Welcome to In God We Trust Academy and Work Session Season 9. We are here, and this is the Lawman Master Merchant Tax Series. Again, 10 volumes, 10 weeks, every Monday, 11 a.m. Central Time, Wednesday, 6 p.m. Central Time. Always give thanks for you guys' participation. You guys could be doing anything else, but you're choosing to rock with us and make yourself present here. So always very appreciative of that as well. Give thanks to the Most High for everything that has transpired up until this very moment, allowing us to have the meeting of the minds here today and being able to gain knowledge and wisdom and to be able to apply these things in our life on a daily. Everything that you hear from this point forward is for educational, religious purposes only. So anybody seeking any type of legal advice, please do seek a legal advisor, as it is my religious duty to speak from my religious experiences and truth with you guys. And my freedom, life, liberty, etc., and the pursuit of happiness is all part of that religion to me, life itself. So, with that being said, how y'all doing here? How is y'all doing here?
Doing great.
Glad to be here.
Doing great.
Awesome.
Great.
Awesome.
Okay. Y'all sound like y'all good. So y'all ain't missed nothing. Y'all ain't missed work sessions or nothing. Y'all been straight, right?
Great. No, that's not true for me.
Y'all been great out there. So y'all know what time it is right now. Before we get started, I kind of expect this first one to be a little long-winded today. So if you got time to kick it, we kicking it. If one of the cameras go out, the battery went out, oh well, we gonna keep talking. So you can just watch from that point. All right, but let's see. We got any testimonies right now today? Any testimonies? Any testimonies today?
I put it in a summary judgment on a reconveyance case in my house.
Okay, that's dope.
And I applaud you. A lot of your understanding helped me with the discovery process and really cornering them in a corner with the information and the evidence. So right off of that, you really put it down.
Man, you did that. Appreciate you for making the application of it. Can't wait to hear more. Anybody else? Anybody else? There's going to be a lot of people just don't even know we having work sessions today. Going once, going twice, going 3 times. Well, I have received a lot of testimonies from people. So over the course of time that we haven't been here, I'm going to give them a chance to speak for it on themselves within the next couple of weeks or whenever they tune in. If they don't, I will definitely share those things with you guys as well. All right. So with that being said, y'all ready to get started? We ain't got no time to waste.
Yes, sir.
We ain't got no time to waste. we don't have the time to waste. All right, so let's get this started. Let's get this show on the road. The Lawman Master Merchant Tax Series. This is volume 1. So let me explain to you how we're going to do this. Today we're going to literally, all right, we're going to go through volume 1, specifically want to finish much of it as possible as we can within the span of hours that we do have. Might do a little few questions here and there at the end, but for the most part, if we do ever finish the volume on Monday, then that means we'll have, speak about more of it in the questionnaire performance and things of that nature on a Wednesday. All right. Or if we haven't fully finished it, we'll finish the book Wednesday, and then answer questions, etc. Wednesday as well, too. So do everybody understand the method and program right now?
Yes, got it.
All right. I just want to make sure. So we stay focused. All right. So this is taxpayer classification of jurisdiction. Now, the reason why I wanted to do the tax series, because I mean, man, tax. And I said, you know what? I think a lot of people run from this particular area, so I want to tackle it head on and just whatever. Let's go at it full-fledged. Let's cover everything about tax law, from top to bottom. Let's get into it. We want to know what everything means. Not some of this, not a little bit here and there, but all of it. And we want to be able to make the best decision that we possibly can make based upon the knowledge and information that we have about tax classification. And I think that's very important when it comes to being a taxpayer or not a taxpayer. And a lot of people think that just because you are a national or citizen or whatever, you're considered a taxpayer. But the truth, that's not true. Everything is done by classifications of persons, which also means based upon how you do business. So we're going to figure out and find that out more and more as we go. So this is volume 1, taxpayer classification here. Very well put, the great series that we got here. Now, this is to make you a master in this area. I do want you guys to know that. So take your time. This is also going to be something that you can put in your law library. It's going to be 10 volumes of this. So just stay along with us. So the term taxpayer is not a casual label. It is a statutory classification. Okay. Under federal law, a taxpayer is defined only in relation to existing internal revenue tax. 26 U.S.C. 7701 A14 defines a taxpayer as any person subject to any internal revenue tax. This definition is conditional. It does not say any person. It says a person subject to a tax, right? So now this means taxpayer status does not arise from existence, residence, citizenship, or earning money. It arises only when a statute imposes liability on a defined class of persons. In ordinary speech, people use taxpayer to mean anyone who works or files a return. Well, that is colloquial usage, which literally just means ordinary speech, things that are not literally, but still we say it every day, like how you use person. It is not legal use. Courts do not apply. I'm going to say it in the sense you can understand it. So courts do not apply ordinary meanings when, everyday terminology when determining liability. And you got to understand it from that perspective because, again, this country in the United States of America, the way we speak is not according to the way the law is written. And I think that is the disconnection. When I watch international movies and things like that, the way they dialogue in their movies is according to their law. And that's what makes the actual difference, right? So now, what you got to understand from this point is that courts do not apply these meanings, all right, ever. The Internal Revenue Code does not contain a global definition that automatically includes all individuals. Instead, each tax is imposed by a specific liability statute, and only persons within that statute scope are taxpayer for that tax. The IRS cannot expand the definition by policy, publication, or assumptions. Agencies administer law. They do not create status beyond what Congress enacted. So a person becomes a taxpayer only when liability statutes applies to them. Examples includes 26 USC 1, income tax on taxable income of individuals, 26 USC 11, income tax on corporations, and 26 USC 1401, self-employment tax. Each statute applies to a defined class, not universally. If a person does not fall within the class described by the statute, taxpayer status does not attach, regardless of filing history or IRS belief. Filing forms does not create liability. Liability must exist before filing. Tax law regulates statutes and roles, not human beings as such. Courts have consistently recognized that the Internal Revenue Code operates on a legal relationship and activities, not on a natural existence. A living individual is not taxed by default. A taxable status is tax. The word person in tax law is term of inclusion, not identity. So 26 USC 7701A1 defines a person to include entities such as corporations, partnerships, trusts, and estates. Inclusion depends on context and application. Being alive, having a name, or holding a social security number does not make someone a taxpayer. None of these appear in any liability statutes as triggers. So taxpayer status arises through four lawful mechanisms only. Congress frequently allows individuals to elect into tax treatment. Once made, an election can carry ongoing consequences, right? Elections must be authorized by statute and are often irrevocable for a period of time. Contract, employment agreements, benefit participation, or other contracts can place a person within a taxable framework. So the obligation flows from contract, not from existence. All right. So activity here. So certain activities trigger tax statutes, such as operating a trade or business, engaging in taxable exchanges, or acting in fiduciary or representative capacity, which is all forms of class of persons. Do understand that? The activity must be one described by statute. Income alone is not sufficient without statutory inclusion. So presumption is that it arises when a person acts as if a statute applies, most commonly by filing returns or making representation under penalty of perjury. Presumptions are rebuttable, but only if addressed timely and lawfully. Voluntary versus mandatory taxpayer status. So the federal income tax system operates under voluntary compliance, not voluntary liability. Voluntary refers to the method of self-assessment and reporting. See, you volunteer to report the way you report, to classify your transactions, etc. Not to whether the law applies. Courts have repeatedly confirmed this distinction. A tax is mandatory only if a liability statute applies. Compliance is voluntarily in the sense that the system relies on individuals to self-report rather than be pre-assessed. Simple. So participation matters. When a person voluntarily files return, reports income, or claims deductions, they are making legal admissions that the tax applies to them. Those admissions can create ongoing classification unless corrected through lawful procedures. So are you aware of how you are classifying the transactions, the entity, etc.? That's what you got to truly ask yourself, right? So are you aware of those things? Okay. So now, those emissions, guys, okay, you have to truly be aware of. A tax is mandatory only if a liability statute applies. Participation matters, but when a person voluntarily files returns and reports incomes or claims deductions, they are making legal admissions. Okay, so participation does not change the statute. It changes the record. Once a person files as a taxpayer, the IRS is entitled to rely on the representation unless it is rebutted. The burden then shifts to the filer to prove the filing was erroneous or unauthorized. This is why classification must be determined before filing, not after enforcement begins. Taxpayer creation here, so this is what you should do. Before someone can lawfully be classified as a taxpayer, all of the following must exist. Is there a valid liability imposing statute? Clear inclusion within the statute's defined class, a taxable activity or event described by law, jurisdiction over the person or transaction, and no applicable statutory exclusion or exemption. If any one of these elements is missing, taxpayer status does not lawfully attach. That's it. So the following are warnings that taxpayer status may not exist. No citation to a specific liability statute, reliance on filing history instead of law, use of IRS publications instead of statutes, assumption based on citizenship or residence alone, enforcement without jurisdictional analysis. And when these appear, the issue is not tax evasion. Tax evasion is just misclassification. So how are you classifying your situations, your transactions? And the truth is, most of you guys always classify everything on a personal level. When you really and I have to speak from biblical aspect because that's just what I was raised in. But when you look at it, the Bible literally tells you to own nothing, that all things belong to God, and that our whole life entirely belongs to God. And we must operate in that sense. So when you do that, that changes the classification of your tax status, whether it's operating from a trust perspective or et cetera, whatever. But it takes a whole lot of personal liability away from you. And I think that a lot of people don't understand that. You're automatically by default are considered self-employed, everyone, no matter what you do. Even when you at home, it's considered that you are using your property in a gain of value, right? Anytime that they assess a value to your property, et cetera, it goes up and they look at that as a gain of income and wealth. But is it or is it not? You got to truly understand. But if you holding it personally, it is. But if it's being held and it don't belong to you, and it's being held for, I don't know, religious aspect reasons and other things like that, then there is no there's no taxable event for that particular property. I'm just kind of throwing things out there, right? So just to give you an idea of, are you aware of how you are classifying yourself, or are we just taking your W-2s and all this type of stuff? You run it to a taxpayer and say here, and then they file it, right? And they're filing just based off process and procedure, not really true understanding of it, but just this is how you do this. This is why you do this type thing, right? But it's hard for people to truly understand what a taxpayer is. Most people that prepare or do taxes in certain forms, if you talk to them, they're not going to explain taxpayer to you like this. They're just going to say, you're a U.S. citizen, then you must pay taxes. That's it, right? Chapter 2, jurisdiction, nexus, and authority. Jurisdiction is the first question, not income. Jurisdiction is the threshold issue in all tax matters. So really, we're talking about authority, then jurisdiction. And again, this is the Lawman series and everything. Without jurisdiction, no inquiry into income, filing, or liability is lawful. Courts do not reach the merits of a tax claim unless jurisdiction is first established. Income has no legal relevance unless the taxing authority has lawful power over the person, activity, or transaction. See? It's about the person, the classification of the person, the classification of the activity, and the classification of the transaction. Are you identifying those things? This principle applies equally to federal and state taxation. A tax imposed without jurisdiction is void, regardless of the amount of income alleged. Jurisdiction is not assumed. It must exist as a matter of law and fact. The government bears the initial burden of establishing that it has authority before it may impose or enforce a tax. Subject matter jurisdiction. Subject matter jurisdiction refers to the legal authority of a government to impose a particular tax at all. Congress may only tax under powers granted by the Constitution, that's authority, and states are limited by their own constitution and federal constitutional constraints. If a tax statute does not apply to the class of persons or activities involved, subject matter jurisdiction does not exist. See? No amount of income or reporting can cure this defect. You know? So how are you moving? How are you classifying yourself? Subject matter jurisdiction cannot be waived, created by consent, or supplied by administrative practice. Then you got personal jurisdiction. Personal jurisdiction concerns the government's authority over a specific person or entity. A taxing authority must have lawful connection to the person it seeks to tax. Mere existence, nationality, or residence is not sufficient by itself. The relationship must satisfy constitutional due process requirements, including notice and legally cognizable connection to the taxing authority. If personal jurisdiction is absent, enforcement actions are unlawful, even if a statute exists. Territorial jurisdiction limits where a government's taxing power may operate. Federal authority is not unlimited geographically, and states may only tax within their lawful territorial reach. A transaction or activity occurring outside the taxing territory cannot be reached absent a statute that lawfully extends jurisdiction and satisfies constitutional limits. So, territorial jurisdiction is especially critical in multi state, interstate, and trust based arrangements. All right. So, nexus is the connection required between the taxing authority and the person, property, or activity being taxed. So, without nexus, jurisdiction fails. Nexus is not presumed. It must be established through objective facts that satisfy constitutional standards. So, a taxing authority may not rely on convenience, assumptions, or administrative shortcuts to establish nexus. Now, if you are like, and the only way I can put it to y'all is like this. If you go buy food right now, they got what they call a consumer tax or things of that way of nature, or they try to put a tax on all these type of different things coming from these corporations. But the truth is these corporations are supposed to pay these taxes, but taxes placed on you. But in the manner of, it's because of the actual classification of the transaction and the person and the activity. When you start looking at those three things, then nobody knows why you went to the store. If you went to the store to buy food, what was the food for? Was it for personal, business, etc.? Taxation. Or are you eating according to your dietary religious form of belief? That changes the activity. That changes the person. That taxable is not a taxpayer anymore, and it also changes the transaction. Are y'all hearing what I'm telling you guys?
Yes, sir.
Y'all sleep out there.
Yes.
Ooh, that's good. I hear
Absolutely.
you.
That's good.
Loud
That's
and
good.
clear.
Yes.
Like, I'm trying to help you truly understand, like, what it means according to the forms of activity that's being taken place. Also, certain things are not in the form of taxation if it is a form of business expense. So if it's an activity, et cetera, it's a form of deduction, right? You can deduct these business expenses. If it's trust expenses, taking care of the trustee or taking care of certain things the trust has to do, those are non-taxable events as well, too. Are y'all hearing what I'm saying? Or maybe I shouldn't use non-taxable events. What I can say is that they all can be counted as forms of deductions and things like that. So it's to understand the activity. It's to understand the person. Just because you're alive, and every transaction is not the same. All activity is not the same, and you're not the same person in every single transaction or dealing with whatever activity. See, it matters about classification. How do you classify it? And remember, this is all voluntary. They don't know. This is not pre-assessed. How did you volunteer to classify yourself as a person, activity, and the transaction? That is how taxes is voluntary. Do everybody understand that so you can get rid of the bullshit theory they give you out there?
Yep.
Clear.
Yes.
And anybody got a problem with it, we got the law to back it up. It's right here in our face. It just takes the time to read it, understand it, and operate with knowledge and wisdom in the perspective. Be wise of the way you move, right? Nexus arises only when a person engages in a conduct that the law explicitly connects to the taxing authority. This connection must be substantial enough to justify the exercise of power. The Supreme Court has consistently held that minimum or attenuated contacts are insufficient. The nexus must be real, purposeful, and legally relevant. Physical presence refers to tangible connections such as property, offices, or operation within a jurisdiction. Historically, this was a primary basis for nexus. Statutory presence arises when a legislature lawfully defines activities that create jurisdiction even without physical presence. However, statutory presence must still comply with constitutional due process and commerce clause limits. See, takes us all the way back to authority, jurisdiction, due process, neutrality, things of that nature. It's going to be that every time. A statute cannot create nexus by declaration alone. The underlying connection must still exist in fact and law. Okay? So economic nexus is based on economic exploitation of a jurisdiction, such as deriving income. right? Such as deriving income from within. This concept is limited and context specific. Assume nexus occurs when authorities treat income receipt, banking activity, or filing history as proof of jurisdiction. This is legally insufficient. Economic activity must be substantial, purposeful, and statutorily defined. Assumptions are not evidence. Just because money went to your bank don't mean nothing. What was the what is it? What is the classification of the purpose of the transaction, of the activity? All of that is what matters. And see, people got to start thinking. We just go in there and say, "Here you go, do my taxes." It's, no formal classification. There's no questions being asked to you about the classification of how you of these transactions or the money that goes into your account. None of that. They all by presumptions until you make it known and express it voluntarily, right? Do understand that. So federal and state taxing powers arise from different sources and operate independently. Once one does not imply the other. Federal tax jurisdiction exists only where Congress has enacted a valid tax statute and the person or activity falls within its scope. Jurisdiction depends on statutory inclusion, not on general federal power. Congress may tax only as authorized by the Constitution, and the IRS may act only within the limits of enacted law. Federal jurisdiction must be proven for each tax and each period. Well, you got to understand, income is just gain. It's a gain, it's wealth, things of that nature, and it all has to do with commerce. So if they're going to do any taxation, the only thing that could be taxed was commerce. Congress had the power to regulate commerce. That's what y'all got to understand about what Congress had the power to do. Regulate commerce, to regulate the public safeties and to certain things of that nature. But it's all in a commercial avenue and venue. You got to understand that part, right? So when state jurisdiction exists, state may tax only where they have lawful jurisdiction under their constitution, consistent with federal constitutional limits. State tax authority requires territory connections, sufficient nexus, just like all the others. Compliance with due process, commerce clause protections. A state may not tax merely because income exists or because a person once resided there. When neither applies, there are lawful situations where neither federal nor state tax jurisdiction exists. This occurs when no liability statute applies, no nexus exists, the activity falls outside territorial reach, which is usually all religious every single time, and constitutional limits bar enforcement. In such cases, taxation is not deferred or reduced. It is unauthorized. So the burden of establishing jurisdiction rests entirely on the taxing authority. This is a fundamental rule of law. So a person is not required to disprove jurisdiction until it is first asserted with evidence. Silence or non-filing does not create jurisdiction. It don't, ever. Who must prove jurisdiction? The government must prove the existence of a valid taxing statute. Applicability of that statute to the person or activity, sufficient nexus, lawful territorial reach. Failure on any one point defeats the jurisdiction. And what happened when jurisdiction is not proven? Well, when jurisdiction is not established, assessments are void, enforcement actions are unlawful, liens and levies lack legal foundation, courts lack authority to proceed, and jurisdictional failure is fatal. It cannot be cured retroactively by filing payment or administrative assertion. So, just understand that. It's very important that we know. So now let's talk about filing obligations versus tax liability. You have an obligation to report if there is a form of tax or report income. That's an obligation. Now, the obligation of reporting and and then having a liability to be paid is two different things. Two total different things. I want us to know that. Two total different things. All right? I want us to know that. So, filing a return is a procedural act. Tax liability is a substantial legal condition. The two are not the same, and the law treats them separately. A filing obligation exists only when a statute requires a return to be filed. Liability exists only when a statute imposes a tax. One does not automatically create the other. Courts have long recognized administrative procedures cannot create substantial liability. Any agency must require forms only when Congress had imposed a duty by law. Filing is a method of reporting. It is not proof that a tax is owed. See? It's all about classification of the actual person, activity, and transaction. A return does not determine whether a tax applies. It assumes that determination has already been made correctly. Why filing does not equal liability? Because no statute states that filing a return creates a tax liability. Liability must exist before filing, or the filing has no lawful foundation. The Internal Revenue Code imposes taxes through specific sections. Filing provisions exist separately and operate only after liability is triggered. This distinction is critical. Many people assume they owe tax because they filed. In law, it works the opposite way. You file because you owe, not you owe because you file. How filing can create liability where none existed. Although filing does not lawfully create liability, it can procedurally establish it through omissions. A return is signed under penalty of perjury. Statements made on a return are treated as declarations of fact unless rebutted. If a person reports themselves as a subject to a tax, the IRS is permitted to rely on that representation. It is an affidavit, just so you know, which is you clearly volunteered to say everything is true. This is not because the tax applies automatically, but because the filer has self-identified into a taxable class. The liability arises from the omission, not from the statute alone. This is why filing without first determining obligation is very dangerous for you guys. But if you don't understand classification of the person, the activity, and transaction, then you're never going to be able to determine. Never going to be able to fix it. So, a filing requirement exists only where Congress has expressly imposed a duty to file. Filing duties are created by statute, not by IRS policy, forms, or publication. The most common filing statutes include 26 U.S.C. 6011 and 6012, but these sections do not apply universally. Each filing statute applies only to persons made liable for a tax under another provision of the law. So, a filing statute must meet two conditions. It must clearly require a return. It must apply to the specific class of persons involved. If either condition is missing, no lawful filing duty exists. Example, 6012 requires returns from individual liable for income tax. If no income tax liability exists under the code, 6012, subsection 6012, does not apply. The statute does not say all individual. It says individuals meeting statutory criteria. Who those statutes actually apply to? Well, filing statutes apply only to persons within the jurisdiction of the taxing authority, subject to a liability imposing statute, not excluded by exemption or exception. Filing obligations do not arise from income alone, gross receipts alone, or account activity alone. They arise from lawful inclusions without a taxing scheme. So this is why filing must always be analyzed after jurisdiction and taxpayer status, never before, because it's all voluntarily. You are volunteering how you do this, how you classify your person, how you classify the activity, and how you classify the transaction. It is all you. If you learn to control that and to identify those things, then I promise you, half the stuff that you pay taxes on, you would be refunded back on for sure. They would not do withholding. You probably wouldn't do any form of withholding on your labor in exchange. See, labor, they try to look at it as a form of property. But your labor is also something that you use to bargain. I'm going to say that. You use to bargain. And bargaining is not gaining any form of wealth, right? It's an exchange. It's an equal exchange of value. It's just a swap. There was no grand in that. And now, based upon that labor, what is that labor for? Well, you go and labor because of what? In relation to your religion, etc., things of that nature. Now we changing the activity, we're changing the person, and we're changing the transaction. I don't think you guys hearing me, so we're going to keep moving forward. All right, so There are lawful circumstances where no filing duty exists, even if money was received or transactions occurred. No filing is not evasion when no statute requires a return. It is compliant with the limits of law. Non-filing, is lawful where no liability statute applies, jurisdiction is absent, the person outside the taxable class, income is excluded or non-taxable by law. The activity does not trigger a filing statute. In these cases, a filing return would misrepresent facts and potentially create a false record. Misapplied filing thresholds. So filing thresholds are often misunderstood. Thresholds apply only after a statute applies to the person. Thresholds do not create liability. They merely define when reporting is required for those already subject to the tax. So just because it says that you got to report the tax on this amount of days, and if you don't, then it's going to be considered late. There's going to be penalties and fees. None of that shit matters if it don't apply to you. If there's no classification of your person, of the activity or transaction in related to the statute, it does not apply to you. But all of this is in your mind, guys. Nobody knows what you're doing until you open your mouth and say something, put it on the record, and then say this is true and then this is considered facts. Are we doing it to ourselves, family?
We did.
We got to be real. Are we doing it to ourselves?
Definitely are.
We've been participating in the system so long and haven't even sat down to actually just read to gain a true understanding of our situation. That can no longer happen. As a man, I can't do it. As the head of my family and household, etc., I can't do it. I can't blindly just go out here doing stuff no more. I can't accept that. And see, when you start going to digging to know and wanting to know who, what, when, where, and why, see, people don't like that. Hey, just do it because we've been doing it for this long. It's tradition. No. Your traditions cause me hell. Are y'all getting it yet?
Yeah.
It's time to make our decisions based on verification, not just what we was told. Do you agree?
Yes.
Agree. Yes, sir.
Yes. Definitely.
It's got to be done that way. The trap of just file anyway is not a legal rule. It is administrative convenience that often works against the filer. Protective filing is frequently recommended by preparers in the agency, but it has a serious legal consequences. Right? How protective filing becomes self-incrimination? Well, it admits taxpayer status, it admits jurisdiction, it admits liability, and waiver objections they never raise. These admissions are then used to justify assessment penalties and enforcement actions. Once made, reversing those admissions requires formal rebuttal and often litigation. It's going to take you some time. Why silence is sometimes the lawful position. Where no filing duty exists, silence preserves rights. The law does not require a person to volunteer into jurisdiction or liability. Non-filing, when lawful, keeps the burden where it belongs on the government to prove jurisdiction, statutory applicability, liability. Silence is not defiance. It is refusal to make false admissions. But here's the thing, guys. I'm not telling you just don't do no filing. What you got to do is be prepared. See, if you are a record keeper, as you should be, because you are standing in operation of the register owner, which is your legal entity, it's the register owner. Everything is placed within its name. It deserves all dividends, interest, and principal payouts, etc. Right? All right. So you are just the one who is controlling and operating those funds. But see, if that's the case, then we got to be great record keepers. We got to keep up with every single thing that is taking place so that when they do come, hey, here you go. It's out the way. Now they're going to see that the classification of the person, the classification of the activity, and the transaction. And there's nothing they can do because they don't got any records no more than what you show them. Y'all got to start understanding that part. All this is based on you. You are causing yourself a hard time for the lack of knowledge and understanding that you have about taxation. Right? It's just that simple. Classification matters, okay? Classification matters based on the person, activity, and the transaction. You're not liable to have to pay a tax because you have to report. The obligation is to report. Once you make the report, but then you might not have to report nothing because it what? Does not classify and apply to you. So if someone makes a claim against you, it's your duty to what? Show rebuttal. Now when you do a rebuttal, it shifts the what? The burden of proof on who? The government. Or anybody that's making a claim against you. I don't care what we're talking about and what area we're talking about, guys. It all works the same if you're really listening. Equity is there. Law is there. Law has to be there. Authority, jurisdiction. You see what I'm saying? All of these things have to apply. And now equity says that, okay, we're consistent with the law. If you consider these transactions, et cetera, classified him as whoever as a taxpayer, equity abides by law and paid. But if equity says that, okay, there's no full classification, it does not apply to you, then you don't have to report. You don't have to do these things, right? So where equity is, where the law is consistent, equity is too. But where the law fails, equity balances everything out. Right? It's just a fact. Understand that. All right. So why silence is sometimes lawful position. Where no filing duty exists, silence preserves rights. The law does not require a person to volunteer into jurisdictional liability. Non-filing, when lawful, keeps the burden where it belongs. Of the government to prove jurisdiction, statutory applicability, liability. Silence is not defiance. It is refusal to make false admissions. Simple. Very simple, guys. That's all we got to do. See, now that we actually reading and diving into this even more and seeing it for yourself. Now it don't sound like just because you declared a citizen or a national or none of that says anything about tax paying, right? Doesn't make you a taxpayer. It's all about how you classify yourself is going to determine, are you a taxpayer? Capacity versus identity. Identity answers the question. So in chapter 4, natural persons, fiduciary, and agent. So identity answers the question who someone is. Capacity answers the question in what legal role they are acting. The law imposes duties, liabilities, and obligations based on capacity, not identity. A name, whether written in uppercase, lowercase, or mixed form, does not create a legal obligation by itself. Names are identifiers. They do not establish liability, jurisdiction, or statutory inclusion. Why? Because all of it goes from authority to jurisdiction, etc. Just because there's nothing in the Constitution, there's nothing in statutory law that says that this is written in uppercase letters. This give us the legal capacity and jurisdiction to do such and such. If it ain't written, it don't exist. Everything is based upon presumptions, based upon the actual classification of the person, the activity, and the transactions that you're having between the government itself. Do everybody got that?
Yes. I
Yep.
hear you.
Because all of it's in your mind. If you believe you're a taxpayer, you're a taxpayer. If you believe you this or that, then that's what you are. If you believe certain courts and tribunals apply to you, then it does. But if you know who you are as the people, and the only correction of status is that you have to understand who you are as the people, guys. That's it. You got to know the law. People just stop knowing the law. You start depending on lawyers, and if anything happened, you're going to go to a lawyer. But a lawyer only has statutory provisions to do stuff because it still is created as a corporation. Law firms, etc., are creatures of the states too. So there's limited jurisdictions on how they can apply and do things. Why? Because it's written in statutory, right? You understand that part. This is a real situation that we got to start coming into terms with here, right? Courts determine capacity by examining what? Function, authority, and conduct, just like I just said. not by examining spelling conventions or labels. What matters is the role of a person occupies in relation to a statute, contract, or duty. Contract also meaning the Constitution because it is the highest contract. Every other contract, no matter driver's license, pistol permits, whatever, it doesn't matter. It all subordinate contracts. And if those subordinate contracts at any given time cause a conflict of interest between the Constitution itself, U.S. Constitution, and state Constitution, either or, it's void. It ain't voidable. It's already void. But everything still goes back to you as the people. Are you applying the law? Right? So if capacity is misidentified, the entire legal analysis collapses. A person cannot be held liable in capacity they never lawfully assumed. So courts look to objective evidence. This includes the legal authority under which a person acted, the nature of the act performed, the statute or contract governing the act, the manner in which documents were executed. Again, person, activity, transaction, classification. What is the capacity? Capacity is inferred from what was done and under what authority, not from how someone describes themselves after the fact. If a person signs a document in a representative role, the court treats the act as representative. If a person acts without authority, the act is void, not voidable, it's void, or personal depending on circumstances. So a natural person is a living individual. A legal actor is a role recognized by law. The two are not interchangeable. The law does not regulate human beings as such. It regulates activities carried out in legally recognized capacities. See? Classification again of the person, activity, and transaction. This is why statute speaks into terms of taxpayers, employers, fiduciaries, officers, and agents. When a natural person steps into a statutory or contractual role, they become a legal actor only for that role and only for that purpose. That's it. Outside that role, the law has no authority to impose duties tied to it. But again, if you as the living individual do not know this, then it all applies to you because you're going to think you do. Every bit of it. You think that municipal tribunals apply to you. You think that you are a resident in a city. You're going to think all of that. You can never, the people can never be a resident in the city. Why? Because you live on the land. You don't live in the city. The city actually resides in the state. It's a creature of the state. So how something that the people created the state created the municipality. So how are you going to live in something that the state created? That does not make sense. It's backwards. It breaks the chain of title. It breaks the hierarchy. But remember, it's all about what you answer to. Again, classification of person, activity, and transaction. Y'all quiet. Y'all wasn't ready for today, was y'all?
Shit, I was.
Yeah, a lot of people like, we talking about taxes and we can't talk about nothing else. If you listen, then we talking about it all. It all applies.
Man, keep going. Keep going. Good job.
I'm listening.
We talking about it all. Because even when we say tax also means what? Duty and obligation. Duty and obligation to what? Perform a statute. Duty and obligation to perform a contract. Duty and obligation to whatever. That's what tax means. So now that pays us back to what? Performance. Which is why classification of person, activity, and transactions is very important. In all situations, whether criminal, civil, taxation, whatever, it still all matters. All right. So now, why the law regulate roles, not beings? Regulating roles ensures predictability and limits power. A government cannot lawfully impose obligations on someone unless the person has entered a legally defined relationship. This is why liability statutes always refer to roles such as individual liable for tax, employer required to withhold, fiduciary responsible for filing. Without a role, there is no duty. Without a duty, there is no liability. A fiduciary acts for the benefit of another under a duty of loyalty and care. Fiduciary capacity is not presumed. It arises only by law or by agreement. When acting as fiduciary, a person does not act for themselves. They act on behalf of a separate legal estate or interest. So let me help you guys understand something. All right. And what I'm finna say right now, I'm finna kill all this bullshit everybody been talking and thinking, right? Including the old me or what I used to think about this stuff. Here's the thing. There's a such thing as called merger of the titles. Anytime that you are in a role of fiduciary capacity and you are the beneficiary, that is a merger of titles, and that automatically means that you're just the outright owner and who holds all full liability to everything that takes place. You have full rights and ownerships to deal with the matter, and you're going to take full liability as well. So when you step into these places and you start going into situations and you try to act from a role of fiduciary and beneficiary at the same time over a same subject matter, it is a merger of titles and it collapses the trust. So there is no more of a trust existence. Now, if you are going to be a beneficiary in certain situations, then guess what? You only have the right to claim or deal with the equitable interest in use, either the use or ownership that you might have in a particular property. That's it. You cannot go and operate in for a protection from a fiduciary status. I just want to make that clear so that you can truly understand. So if you don't understand how to move as a beneficiary to operate from an equitable title for something that you have interest in, because a contract can be used as an equitable title for you, and it also can be used as a legal title for the other party as a creditor and debtor relationship. A debtor has a rights of interest in a contract, so it's an equitable title, and the creditor itself has a interest from a legal perspective. Right? So if it's a legal title, fiduciary perspective, otherwise it's equitable. And you got to know, well, if you merge the two, it collapses and you're standing on the island there to take all liability. So that kills all of that. It kills every bit of it. And if at any time that you want the state to be in a fiduciary capacity for you, well, guess what, people? It places you as a what? Ward of the state. And it means that you cannot handle your own affairs. So you don't want the state in a fiduciary capacity over your estate dealing with any damn thing. So what I mean by that is, well, if you got to go and have a public defender or anyone doing anything on your behalf, even filing taxes. If you go to a taxpayer, it places you in a minor capacity because you're allowing someone else to do something for you that you became incapacitated in that particular transaction and position. Do everybody understand? Y'all see where this is going?
Yep. Let's go.
Yes, sir.
So the truth is, what is status correction?
Becoming the executor of your estate.
The
You already
status you
that.
hold
It's just
over your
it ain't
property,
becoming it. It's just
operating.
controlling it. It's knowing.
It's known the law.
You don't got to go become and go do something, guys. You don't have to become and go and do nothing. It's to operate. It's to act. It's to be. It's to know.
Act that.
It's to protect. We are beings. So who and what are you being? What is the classification of the person, activity, and transaction that you're having with the government or company or corporation at that particular time? You have to be fully aware of all of this. Once you're aware of this, it ain't nothing else to talk about. We can write stuff all day, but the truth is, I don't got to put nothing in writing if I know my rights. I know what my rights is in contracts. I understand what equity is. I understand a fair contract. I understand if I'm a taxpayer in these particular situations. Right? I just want to make sure we know that. Right? A trustee administers property belonging to a trust. The trust is a legal estate. The trustee is not the owner. Tax obligations, filing duties, and liabilities attached to the trust estate, not to the trustee personally, unless a statute explicitly states otherwise, right? So the trustee's signature binds the trust only within the scope of fiduciary authority. They hold no liability. Even when it comes to an executor administers the estate of a deceased person. The estate is a separate taxable and legal entity. Acts performed as executor bind the estate, not the executor individually, unless the executor exceeds authority or commits misconduct. Then you got an administrator who performs the same function as the executor, but it is appointed rather than named. Capacity and limitations are the same. The administrative role exists only for duration and scope of estate administration, which usually comes through probate. Agent is an agent acts on behalf of a principal. The agent has no independent authority beyond what is granted. Liability follows the principal unless the agent acts outside authority or personally guarantees an obligation. So an agent does not become personally liable merely by acting unless the law or contract so provides. Switching capacity without knowing it. One of the most common legal errors is unintentional capacity switching. This occurs when a person acts in a role without recognizing its legal consequences. Capacity is not determined by intention alone. It is determined by the nature of act and the authority invoked. How filing change capacity. So when a person files a return, application, or statement, they do so in a declared or implied capacity. For example, filing a fiduciary return declares fiduciary capacity. Filing individual return declares individual taxpayer capacity. Signing as an officer binds the organization. Once a capacity is declared on the record, agency and courts rely on it unless it is formally corrected. So, how signature binds the roles. A signature binds the signer in the capacity indicated or implied. If no capacity is stated, the law may presume personal capacity. See? They're going to have a default. I told you. Personal capacity, self-employed, sole proprietor, all those specific basic foundation of things is what they're going to imply to you, no matter what, until you say or do otherwise, right? So capacity control framework here. Capacity must be identified before acting, not after enforcement begins. So I am acting for myself or for another. So am I acting for myself or another? When legal authority governs this act, and what role does the statute or contract recognize? Who bears liability in that role? If these questions are not answered, capacity is at risk or being misapplied. So how to determine what capacity you are acting in? Capacity is determined by the document being executed, authority cited, and relied upon, and the benefit or obligation created. The party for whom the act is performed. If the act benefits or binds a separate estate or principal, the capacity is fiduciary or representative. So how to stop being misclassified? That means you need to classify yourself. That's one thing. Explicitly stating capacity on all filings, signing only within lawful authority, refusing to act where capacity is unclear, correcting records promptly when errors occur, and capacity control preserves jurisdiction of offenses and prevents unintended liability. So make sure that you know that. Make sure that you know. So as of right now, one of the main things you should know is capacity, classification. You definitely need to know those two because it matters. How you classify yourself. Now, and see, this is the thing. It kind of sounds tricky, but that's why you got to be aware of your situations, your contracts, how you are operating, because everyone is not going to have the same classifications on the same transaction. That's just like you might see everybody going to the store. So let's say you see a police officer pulls up to a public store. Let's say the fire station pulls up to the public store. Let's say a pastor goes into the public store. Let's say a person that owns a company. All of these people go into the store. Every last one of them, based upon who, what, when, where, and how they own. The reason they went to the store is based upon the person that went to the store in capacity, the classification of that person, the activity, and transaction. Are they going to the store? So let's say that the officers went to the store for the organization. So they're doing this in a specific form of capacity. Let's say even if they pay out their own pocket, right? That's not really a taxable event upon them as well, right? Because they're going to be, one, fully reimbursed. So it's not a form of gain income or anything of that nature. And this is a write-off on the deduction of the actual organization, however they may treat the taxer. So that's another thing. Then you got, let's say the pastor went in. Well, the pastor's going into the store for its religious purpose. It's to keep up in its upkeeping of its, let's say, dietary and its religious view, and to nourish itself to continue the mission. So within itself, that's a non-taxable event, just based upon the person, the activity, and the transaction that's being taken place. And let's say, the fire station, et cetera, it all applies the same. It just depends on who, what, when, where, and how. Like, what's the situation? What's the classification? What's the capacity? Then another person could be going in there and everything they're buying is based upon the trust. Now we got to reflect back to the trust to understand the capacity for the person. Now we got to determine the activity. So what activity, what comes from the trust gives this trustee the power to go and act and go to the store to buy the things that they're buying. And let's say that these things are related into the mission of the trust and the expenses of the trust, et cetera. Well, now we have the classification, the activity of the actual, transaction and the person and their capacity. You just need to be able to know. So yeah, we all could go to the store, but who are you when you go to the store? You Batman? You Superman? You Robin? Who are you? And what are you like? What are you doing? How are you classifying your activity? Yeah. How do you classify the transaction? Opening some minds up, huh? So, individual trust estates and organizations. We're on chapter 5. An individual is not taxable by default. Taxability depends on whether a liability imposing statute applies to the individual in defined legal capacity and jurisdiction. So the Internal Revenue Code does not impose tax on individuals merely for existing, residing, or earning money. An individual becomes taxable only when they fall within the scope of a statute that lawfully imposes their tax on individuals engaged in taxable activity. Income alone does not create taxability, right? The source, character, and statutory inclusion of income determine whether the individual is subject to tax. An individual is taxable when all of the following exists. A federal or state taxing statute applies, jurisdiction and nexus are present, the individual is acting in a taxable capacity. The income or activity is included by statute. So when these elements align, the individual, not because they are a person, but because they occupy a taxable role, is subject to a tax. So when individuals are not taxable, is no liability, jurisdiction is absent, income is excluded, exempt, or non-taxable by law. See, that's what you got to pay attention. Is income excluded? Is it exempt? Or is it non-taxable? And that's based all on the activity, the classification of the activity and transaction, even the person. So the individual is acting solely on a fiduciary or agent. In such cases, the taxing individual would be an unlawful expansion of authority. So trust is a separate legal estate. The doctrine is well established in law and essential to proper tax classification. The trust itself, not the trustee, grantor, or beneficiary, is the taxpayer when the law imposes tax on the trust estate. The trustee acts only as an administrator. Failure to respect this separation results in misclassification and improper attribution of liability. So separate legal estate doctrine. Once created, a trust holds legal title to its property. The trust estate exists independently of the individuals involved in its administration. Tax obligations attached to the estate only when a statute explicitly imposes tax on trust or trust income. Personal liability does not arise merely because someone serves as trustee. So when a trust is the taxpayer, the statute imposes a tax on the trust income or activity, taxable income under applicable law, and trust is not disregarded by statute. Now, a trust can also be considered or exercise and hold things for personal reasons and can be passed through entity and stuff like that as well. So it don't be taxable in certain ways. But again, it's all about the activity. It's all about how you classify what is. So when a trust is not the taxpayer, statute attributes income elsewhere by law, the trust has no taxable income and jurisdiction over the trust estate is absent. So in such situation, filing in the trust name would be improper. An estate is created upon death of an individual. It is temporary legal entity recognized for administration and settlement purposes. So the estate exists independently of heirs, beneficiary, and fiduciaries. The taxpayer status attaches only to the estate itself, not to those administering. So the creation of the estate taxpayer status is a decedent estate comes into existence. The estate has income or tax attributes governed by statute. A fiduciary is appointed to administer the estate, and the estate, not the executor or administrator, bears the tax obligation. So an estate exists only for the period necessary to settle affairs. Once administration is complete, the estate terminates. After termination, no further estate tax obligations can lawfully arise. Attempts to extend liability beyond the estate's existence are void. So, understand that. What book am I reading? This is the Lawman Master Merchant's Tax Series from In God We Trust Academy. You can get it on ingodwetrustacademy.com. Before today's over with, it'll be up. So, also, organization and entities are taxed based on form, election, and statutory treatment. The law does not treat all entities the same. Corporations are taxable entities created by statute or charter. Tax liability attaches to the corporation itself. Shareholders are not liable for corporate tax unless law expressly provide otherwise. LLCs, limited liability companies, are classified for tax purposes based on elections and statutory defaults. So an LLC may be treated as a separate taxable entity, a pass-through, which is what I use in God We Trust Academy LLC. It's a pass-through entity. A disregarded entity, a classification controls who files, who reports, and who bears actually liability. Associations may be taxable entities if they meet statutory criteria. Informal organization alone is insufficient. Taxable liability depends on structure, activity, and statutory inclusion. Then you got religious bodies are recognized under constitutional and statutory protections. Tax obligations arise only where the body engages in taxable activity, meaning anything really in commerce. Statute lawfully imposes reporting or tax duties, and jurisdiction and nexus exists. Religious status does not automatically create tax liability, nor does it automatically exempts all activity. So based upon the religious status, we will have the capacity and classification of the person. Now we got to deal with the transaction and activity. Is the activity commercial? If it's commercial, it's taxable. If it's not commercial, then it's a non-taxable event. And then the transaction itself. So it's also based upon, so now it's classified in that area too. And once you do that, then it's a non-taxable event at all times. So truly understand that. Especially if the money is going to be used for other specific purposes that's not, that's part of the mission, et cetera. It's non-taxable. So, like, I even do that for myself, like, for you guys to understand that, like, everything, I don't care what it is. What you see me have on, none of it belongs to me. It all belongs to MNRP. It belongs to the Living Trust and for the equitable use of MNRP and In God We Trust Academy. So with that being said, when you see me, I'm always on ministerial duties. So anytime I'm eating is to keep me functioning for the nourishment for my ministerial duties. So if I go buy food and all of that, it's all for me to continue my religious ministerial duties and things of that nature. So once you start understanding that part, all these events that I'm involved in are non-taxable event. I don't care what money comes in, what money goes out. It all is classified in that aspect because that's how I have built it around my life, my family life, and others. We don't own anything. It all truly belongs to God. Every bit of it. Even when it comes to my jury and stuff like that, it's all in uniform. It belongs to a specific ministerial capacity and things of that nature. And it's also for the, what about sleeping? I mean, I guess if you want to consider it, if you need a specific certain time of rest. Now, see, you don't have to base your life either based upon what you call the traditional religion, because liberty of conscience says that each individual has the right to decide that which is sacred and religious to themselves. Nobody can decide that for you. It doesn't mean that you have to go be in the biggest religion to be classified. You can have just your own way of life and religious aspect. It's always best to write it out fully, But if you go from that perspective, then you'll truly see like why I'm so big on those things in a lot of ways. And that's the reason why when you go and create trust and stuff like that, everybody's is different. Estate planning, it's called estate and planning for a reason because you are planning and your plan ain't gonna be my plan. You know what I'm saying? Even if you might set it up in the same structure, still don't mean your plan my plan. You still might do different things with different, how you maneuver everything. Totally up to you, right? So entity classification, correct classification determines everything. Misclassification is the primary cause of unlawful tax enforcement. So the entity subject to a filing statute files, and filing does not shift merely because a person administered or managed the entity. Who reports? Reporting follows statutory assignment. Income is reported only by the party to whom the law attributes it. So improper reporting creates false admissions and misdirected liability. Who holds liability? Liability attaches only to the entity or state named in the liability statute. Trustees, officers, managers, and agents are not personally liable unless the law expressly imposes personal liability, authority is exceeded, fraud, or misconduct occurs. Very important. Very important. All right. Very, very important. The grantor. So now we're on chapter 6. Grantor versus non-grantor determination. So a trust is treated as a grantor trust when the Internal Revenue Code treats the grantor as the owner or of all part of the trust for income tax purposes. The controlling framework is IRC subsection 671679. Grantor status is not based on what the trust is called. It is based on whether the grantor retains enough control, power, or benefit that the law attributes trust, income, deductions, and credits back to that person. So that means if you still have interest in it, then they still got a right to tax it in your individual capacity. Grantor trust treatment can apply to all trust assets or only a portion of that trust. The analysis is always power by power, asset by asset. Control means retain authority that effectively allows the grantor to direct trust property or outcomes. Control can be direct or indirect. It can arise from powers in the instrument or powers exercised in practice. The key legal issue is whether retained powers are substantial enough that the grantor is treated as the owner under the grantor trust rules. Right? Reversion exists where the grantor can get trust property back or where the trust property can return to the grantor after a period or upon an event. Revisionary interest can trigger grantor trust treatment depending on the terms and time horizons set by statute. So the point is not whether a reversion ever happens. The point is whether the grantor retained a legally meaningful right that the code treats as ownership. So I know a lot of people function and wants to go to grantor, a revocable grantor trust and stuff like that. But again, just remember that you do have rights and ownerships and things like that to it that they look for. So you need to know how to, classify things. Grantor trust status is most commonly triggered by retained powers, especially powers over beneficial enjoyment, distributions, administrative control that benefits the grantor, and certain borrowing or substitution powers depending on how they are drafted and exercised. The law focuses on whether the power allows the grantor to keep the economic benefit or effective ownership. Labels do not matter. The actual legal power does. So how is it structured in your declaration? Because the situs is basically the law of the trust. And once you understand that it is the law of the trust, then you need to be very careful about how you specifically give power and to whom you give power to. And all of that matters. All right? All of it. A non-grantor trust is a trust that is respected as its own taxpayer for income tax purposes because no person is treated as the owner. Non-grantor status depends on whether there is a real separation between the grantor and the trust estate. Separation must be reflected in the document and the operations. A trust can be irrevocable and still be grantor in whole or part if power exists that trigger owner treatment. See? Conversely, careful drafting and disciplined administration can support non-grantor treatment where the statutory triggers are not present. So it matters what you say. It matters the connection that you have within that property. See, me, I only got equitable use. I don't own nothing. I can use it, but I don't own it. Any of it. I don't ever want to own it. You see what I'm saying? And the way I'm set up is this. MNRP, all right, which is the representation of this flag behind me. All right, it is basically a theocratical religious government itself. So when it comes to tax classification with the United States, it operates under a 508 status, right? Which we still have the power to still have full internal government with ourselves, right? But now what this means is MNRP is the actual trustee over, as you guys see on all of my books, even though it don't say it on this, and I gotta change it. It's supposed to say property of Eric Jamar Ingram Bay Living Trust. So now it's the trustee of it. I am the Grand Wazir of MNRP, which is basically the head of state, or like you would consider Donald Trump the president of, right? So, and what that does is I'm also the primary appointed trustee of the Eric Jamar Ingram Bay Living Trust. So now I gave you capacity, all right, and full classification. It's an irrevocable trust at that. Okay, so I don't own anything that deals with it. It is for the mission of MNRP, et cetera. And it's been fully outlined through the Declaration of Citus. So this is why I can tell you anything, any dollar, any penny, any cars, I don't care what it is, all of it's owned by the trust for the beneficial use of MNRP, its officers, and things of that nature. And see, my trust is also built to take care of the families that's within the mission, which is all charitable work. I want y'all to listen, because you got to listen from what I've been telling you. Capacity, you got classification of the person, activity, and transaction. Can you hear it in what I'm telling you? So if I hop in my car right now and go get some gas, it's all for the missionary. I'm always on mission everywhere I go. I'm always studying. I'm always teaching. I'm always speaking. Whether I'm talking to you, anytime we sit down, it could be considered a religious meeting, eating, business, whatever, trust meetings. Every time we sit down to eat, it's trust meetings. And anything I eat right after this, it's all part of me to continue the function of my missionary duty. So that means anything we buy in groceries, it's all classified as such. Y'all listening? They didn't went to sleep on me.
No, we hear you.
We hear you, Coach.
Hit me with it one more time. The capacity of that nature would be. Can you do that one more time?
I'm
Okay.
gonna let you rewind it.
Okay.
Now I'll eventually end up saying it again. I'm just saying it's just the capacity. So the capacity is, what capacity do I hold? The capacity that I hold is as the trustee, but I was appointed trustee, the primary trustee over this trust by MNRP, which is the actual trustee. I'm just a member in MNRP who was appointed to do a duty. So that would be my capacity. I don't own any liability to it. So that means the trust itself is its own full entity. But the trust itself is set up for all missionary and religious purposes. So anything that it does, I don't care what it is. If we get up and we go take a trip right now to go somewhere, it's all in form of educational. It could be for a religious, spiritual trip. It could be for, if I'm going to go come and teach in these perspectives or in places, all of that. It all goes into it, no matter what. Even if it's just going to see, go and see and meet and greet with family. That's part of our religion. To continue to honor our family. to have
Gotcha.
these spiritual and you know, meetings and matters of family to continue the family and legacy and of the mission. So it's just all about what you say. And I keep saying this: nobody knows what you're doing. We all could be on the plane, but guess what? Who are you in capacity of being on the plane? And what for reason? What activity? What is the transaction? Like, what is the classification of any of that? Nobody knows. Right? You just know you're on the plane with people. And you think all people are on there for the same thing, right? But that's not true. You think people are just some people on business trips, religious trips, retreats, whatever the case you may call it. And it has a certain classification that it goes into. That's what matters. That is what matters on that particular time. Let me see where we at. Let me see how much we got to go. We ain't got that much to go. So what I'm gonna do is we're gonna stop on this. We gonna stop on what is that, chapter 6? Yeah. So I will stop on this one. And then we're gonna continue forward when we go into chapter 7. Religious bodies and classification. So let's talk about it. What have you guys learned so far? I don't want to get going too deep in on it right now. I just want to make sure. So this is what this is what work session season 9 finna be about. So I hope y'all ready for it. We're finna break down any walls of unclarity that you do not have. We're gonna give you full clarity of everything. Everything will be clear, removing all smoke and mirrors that has been holding us down. I think a lot of this stuff been psyop and things like that to test you, to see if you make it through. But we here. We are here. We are here, family. So with that being said, talk to me.
I've learned that it's authority and then jurisdiction, and everything is based on the classification of person, activity, and transaction. So it's how we show up and present ourselves on the record that creates the record.
Beautiful. Well said. Anybody else? I want to hear what y'all learn. I'll let you get your questions in a second. Let me hear. Come on now. I know y'all ain't quiet. Do anybody?
I think that sister pretty much summed it up, but in the act of actually articulating that step by step, whether it be on a document or out of in verbally, you would be saying something like I, the person, is appointed by the trust without liability to, and the trust is set up to administer religious and common and commercial duty, some of that nature, to establish that relationship in writing on paper. I guess is what I got from it.
All right. What's up, Heather?
Okay. So I learned about merger of titles, and that basically kills the trust. And that means before there's a merger, you have a fiduciary and a beneficiary. But when they merge, that creates full liability because
Absolutely.
the trust is dissolved. And the beneficiary is also the debtor, and the debtor has rights of interest. And the state is essentially the fiduciary, and we are wards of the state in a minor capacity until we take over as the fiduciary
Correct.
and know our rights. Yeah, thank you.
Well said. And the other thing about what you said about merger type, see, it is that way, but like it depends on the classification of the beneficiary too. Is the beneficiary gaining full right out ownership, or is it only having equitable interest to use. So then you can still be the trustee and still have equitable interest to use. Because for me, I am in the capacity as a trustee for the trust, you know what I'm saying, and appointed by MNRP. So that's that capacity. But as one of the people of MNRP and someone who's sitting in this particular capacity that I'm in also, I also got what? Equitable use. I don't own it, but I got use. You see what I'm saying?
Right.
So I just want to make sure you understand that part too. But definitely great. Thank you for your feedback on that. Anybody else?
And this is the third volume, so this is a big.
So, all right, so in case of, let's say, a property, let's say you, the property is, because the contract always says the, natural person. So you would then be natural person in equitable use of, let's say, your home, unless you put it under the trust, and then the trust would then have the ownership of it. But if you don't have it in a trust, then the state would be the owner of the house and you would be having equitable use under the title of natural person.
Say that one more time.
All right, let's say a house, right? You have a house.
I just kind of heard the background and kind of got distracted, but go ahead.
Okay, so in let's say the house, you live in a house and you don't have it in a trust, but you have equitable, you are the natural person, because that's when you signed the contract, you signed as not realizing it, but they have you under natural person. So now you're the natural person living in the house. The state or the county is the owner of it, unless that property is in a trust, and then the trust becomes the owner of that property.
That's
But
not
without
true.
it,
The
no?
state don't
Okay.
become the owner of anything. Just because it's reported in a public trust, they just have it identified as a certain type of way based upon classification that you're using the property. So that's one thing, but it don't own nothing. You are in the full ownership of it, because now, if you want to take your rights and interests and ownership of it and give it to the trust, then you can do that.
Because all land belongs to God. So, and that man just comes and wants to claim something.
I
Okay.
can't hear you.
I said,
No, because you're the beneficiary title holder.
Yeah, but I didn't even hear it. What did you say again?
I said all land belongs to God anyway. It's just that man comes and tries to.
See, land.
make
See, we
money
got to
on it.
remember this. Land belonged to God. God gave it to the people. The people gave it to the government itself for the use, for any public reason that we may need to use it. That's roads. That's the land that we love for the state and the federal to be able to use. All right. Now, when it comes to you and land and being able to go and get land, etc., then yeah, you have the right to occupy any land that is not being used. That's the reason why if you run up on an abandoned crib, etc., and nobody's in it, that and then based upon the classification of it, you know, ain't nobody been paying the taxes on it. If you wanted to go pay the taxes on it, you wanted to make that right of claim to it, etc., and adverse possession, all different type of stuff. You got that right to do that. You see what I'm saying? That's a right that they ain't gonna never be able to take away from you, right? So now you get to go make a full claim on that the way that you see fit on how you volunteer to classify that. That's on you. But however you may classify that, until it's rebutted, it belongs to either you, the entity, or however you may set it up. So just so we clarify that. Because other than that, remember, yeah, God, all land belongs to God, but God resides in man. And man gave specific lands to the borders of the republic, state, and the federal government in certain situations and aspects to be governed and ruled based upon the civil activity of the people. Let me say it like that. It's very important that we state it that way, because that way you can see that, you know, ownership has never really left the people. It don't leave the people. It's all based upon classification. So if you go and on a deed of trust, it's fully in your name, then it got the right to be taxed according to how you're claiming it, because it can be seen as a gain because of the value continues to go up, right? So it's an increase, and they're
Right.
going to tax you based upon the assessed value that they in their prediction of that particular year, based upon what they call the fair market value. So now what you got to truly understand is how to remove that full transaction activity and classification of the person that's involved, right? So the person can be a trustee who made the filing. Now, if it's in the trust, what reason is it in the trust and what is the trust actually doing with it? So let's determine the activity that it's being used for. All right. Now we got to determine the transaction of the money that it was used. Is it a taxable event, a non-taxable event? That's another thing. So all of this still goes under you truly understanding the classification and the capacity of which you're doing things. But the truth is, none of us should be doing anything in our own personal name because you're going to leave here one day. So
Right.
if you do got everything in your name, then there needs to be a beneficiary. But the beneficiary do not need to be a living man or woman, because once you give them sole ownership, it's going to look like a what? A gain or profit. They're gaining inheritance, etc. So if they're going to gain that, that's going to be taxed. That's the reason why when y'all give the houses to your children and all of that, they being taxed on a situation they can't even pay for. And they ain't never have to be taxed. If it was given specifically to a trust for the benefit of another, then it's going to be hard to tax that specific actual individual, especially if you classify the activity of the land is being used for. There is no classification of anybody's activity of the way the land is being used in their deed of trust. So if you're going to say for personal, well, personal could be mean you could be using it to make money as you're doing stuff there, doing labors for hire and all of that type of stuff. You could let your land be not sold, but rented to be used for certain things, and also they consider to be the assessed value of the land, etc. So it's just like if you choose to futurely sell it in commerce as well, this is the profit that you're going to gain from it. You have to redirect that classification of that. And if we don't, then by presumption, by default, this is what they're going to classify it as. I hope that makes sense to you.
Yeah, that made a lot of sense, and you gave me a lot to chew on. Thank you.
You're welcome. Did that make sense to everybody else?
Yep.
Yeah.
Yes.
Yes.
Something I
So
was
I mean, it's really it's us guys. It ain't even like we can't even. A lot of people will say it's the system. I mean, it is, but it ain't. Like it's still us. Yes, they created statutory laws. Yes, they done certain things, but if they don't apply to you, you shouldn't have let it apply to you. You know what I'm saying? As I keep saying, that we should not be in tribunals that deals with bench trials and stuff like that. Why? Because anytime your liberty is at stake, and your liberty is at stake at any time there's a seizure on your what? Legal capacity. Your legal capacity is considered your property. See, y'all think property is all tangible, physical. No, it's also intangible. Your rights, your religion itself, it's property. It can be damaged. Someone can what? Discriminate against your religion and against you for your practice of that religion, right? All kind of stuff. So that damages your religion if they stop you from doing certain activities based on your religion and allow others. That's, that could even create bills of attainder in certain ways. So this is what you have to truly understand. We have to start learning the classification. We just out here doing everything when the whole game is when you go like, all right, if we're going to move like Christ, then let's move like Christ. What the hell did Christ own? Anybody? I'm waiting.
Nothing.
Not nothing. He never claimed ownership on anything that was on earth. Everything he said was my father's. This belonged to my father. This is my father's. He ain't never make a personal claim on nothing. So why are we making personal claims on anything if everything belongs to the kingdom of God for the benefit of the kingdom of God? But the reason why you can't see that is because you don't operate in that manner. You operate like capitalists. Everybody do. There's no real functioning communities and villages like it used to be for you to truly see the kingdom of God the way it's supposed to operate. Because if it did, you don't own nothing. Everything is for the benefit of the people at all times. That's what we got to get back to. When you start acting like capitalists and stuff like this, then this you own everything. This your asset. This is this, and this is oh yeah. That's you keep moving that way. That's stupid. You know, we watching everybody. You like why the rich people ain't getting? They ain't rich. They companies rich. They trust is rich. They don't own nothing. You just attach it to their name. And just because they attach it to their name in public and on the news and all of that, that don't mean they own it. It's the network of their foundations, not them. Y'all see Jeff Bezos and think, oh, it belongs to him. Nah, his name just tied to these certain companies and things like that in certain capacities. It's not him. He don't own nothing. I guarantee you, he ain't rich. His trust may be. His foundations and corporations and stuff like that. That's the money. He just operate in a capacity that where he gets to benefit from it. No ownership. And if you're not trying to get there, then trust me, America gonna be a living hell for you. Every dollar you earn, you gonna feel crazy about. Every time you gonna hate to go to work, you gonna hate to even go do overtime because they killing you. They gonna take all that money. Stop buying damn tickets in your personal name. Stop, man. Listen, I'm trying to tell y'all something. Stop buying these particular lottery tickets and all of this stuff in your personal name. Let the company get it. Let the trust buy it. Assign it already. Like, you got to know how to move it. You got to learn how to create a non-taxable event on the situation, because if you was doing this because of whatever, nobody know your belief. God could have woke you up out of your dream and said, you need to go do this. And you need to go to this particular place, this particular store, and get this particular ticket, etc. And you need to go do such and such and such, right? All this is done in a religious aspect for the church and for the benefit of the people. None of this is a personal gain or belong to you in any kind of way. You can already establish how, when, where, and where the money going to be used. And let's say you go in, boom, ain't no taxes.
Once you protect your labor contractually with like your trust, then you can use like the law of merger and then collapse the title and like control your equity, right? That's what we're getting at.
You talking about what now?
I was saying it sounds like I was putting everything together, and it sounds like understanding contracts, like she was talking about the living name, but understanding that your estate, that name is part of your estate, understanding that house is part of your estate, understanding that the how to connect contracts between your estate and that trust together so that you can claim your estate underneath the trust. And then the other lady had said something about the merging of titles, and I said once you can have these contracts established and then you can merge some of these titles underneath your trust, then you now can be the executor and control your estate. Is that where we're going?
I mean, it's just, if it's like this, I'm gonna say it in the simplest way. You already in control, but what capacity do you want to be in control in? Do you want personal liability capacity, or do you want fiduciary capacity? And once you bring it into the estate, it just removes certain things. See, and just because you put something in the trust don't mean it can't be, shit in the trust get taxed too, based upon how you classify it. Classify the what? The transaction, the entity itself, because a trust, if a trust is a what they call a complex trust. You know what a complex trust is?
Yeah.
Okay, so for those who don't know, a complex trust is basically when when certain parts of the trust. So let's say a trust creates a corporation, and that corporation operates in commercial activities. Anything that it does and makes, et cetera, that it has to report. So that's a complex trust because it operates in commerce, right? So it can be taxed. That trust can be taxed. You got to understand that part. So just because you got a trust don't mean that if it participate. Remember, it's not just because you create the entity. It's because of the classification of the person, the transaction, and the activity. That's it. It's what you want to do. And that's how you want to be able to identify it in all times, because it's how you fully structure it, family. Is what I want to say. It's how you structure it. And the reason why I say that is because, like, for instance, let me see. I'm gonna read something to you guys. Let me find it first. And to answer your question. Um, I'll answer your question in a minute. Whoever just asked on Facebook, just give me a second. I'm just trying to put everybody to have a better understanding of this stuff, because even if you go get your taxes done by somebody, you still want to be able to articulate and classify everything yourself about what's what. If you want to even take it to them prepared, classified everything already. Make sure they file it accordingly to how you have classified everything. It matters, family. I promise. It matters.
So I need to amend my taxes, coach.
You know what I'm saying? It matters. All right. So, for instance, when it comes to um, like, for instance, like, you got to I do what I call an annual 1099K summary. So that means anything that I get from wherever I'm receiving any type of funds from, I have to classify this now, right? So what I say is all amounts reported and received and administered in fiduciary capacity on behalf of the living trust. The trust conducted continuous religious, educational, instructional, and administrative activities throughout 2025. Receipts were classified and administered pursuant to the trust accountable plan and recorded monthly. So actual expenditures were recorded monthly across Schedule A through D. So I got a ministerial residence, transportation, nourishment, household, education, ceremony, regalia, and office as well, supported by receipts and descriptions. So, and the thing is you can't separate my home and my work, if that makes sense. If I'm trying to show you guys on what I'm saying, and there's no separation in it. So since you can't separate those two, yeah, it's gonna put you in a position. And you got to learn, how do you separate those two? And a lot of people don't really know, because you can't separate me from my ministerial duties in my home. It's all the same. So that means now, if I was to, like, anything, if I had a mortgage, if I had a rent or something of that nature, anything that I specifically pay into it automatically is for religious aspects and purposes. So now it's showing that the money that was being taken in is being used for this purpose and activity and transactions and stuff like that. It's not taxable because of what we're using it for as well. All right. Do everybody get that part?
Yep.
Yes.
Y'all sure?
Oh yeah.
Do you get that part? See,
Yes.
also,
So
for instance, if I let's see, the trust, also my trustee, it says the trust funds may lawfully be used for the following charitable and religious purposes. So financial assistance to MNRP members or their families, housing, food, medical, educational release, religious events, outreach, materials and printings, stipend wages, honorariums to ministers, trustees, and missionaries, emergency support and humanitarian aid as well. So I can do that. If I need to take care, help people, etc., you know, it's done. It's already considered a charitable purpose. So if I had to donate, help anybody with any type of something, it's already been classified. See what I'm saying?
Gotcha.
So your trust files
monthly and then you file your monthlies for the annual.
You gotta break that down a little bit better. What you mean?
Okay, because you said that your trust does the 1099K for the annual, but
Yeah.
then you also stated that on a monthly basis you also
See, I get it.
record
You
as,
get a 1099K annually anyway from anywhere you're doing banking, anybody receiving any type of money, right? Or any interest as well. So that's you're gonna get that. Once you get that, only thing it's showing is the amount of money that came through that account monthly. Well, I already got monthly ledgers that show that. So I just put it together. It's already there. And I just write a summary for it. And then there I stay put together. There's no reason for me to file. It's not none of it's taxable events. So, but if they ever come, it's already there. Here you go. You go through that shit. I'm not going back through it. But it's there. It's already been classified. Now, what matters is it's not just a ledger because now it has to go back to the authority. Right? Has to go back to the authority. And that's what we have to be able to approach from as well. So I'm trying to see something else. I'm going to show y'all something. See if I can find the other part I was going. I hope I saved it. At least I thought I did. Let's see. I thought I saved it. Maybe I didn't. Let's see. Maybe I didn't. Let me see. Oh, okay. Yeah. Okay, it's all there. So, like, even for when it comes to like the use of cars, etc., like all of that's in there as well. Ah, you know what? I don't know if I did save it. I might need to go look it up and see because I don't see it on here. Maybe I put it somewhere else. Anyway, I'll find it later. I'm not gonna keep looking for it. But anyway, so what I'm saying is I'm just trying to show you guys how I have everything classified. Everything. Everything has to be classified. You need to give a specific reason how and why it's used. And then when you start making those reports, because you got to understand the only record out there is whose record?
Ours.
our
Yours.
record. Yeah.
So who can rebut you? See, they only thing
Nobody.
they get to do is make a presumption. They get to presume. It's up to you to say, okay, here, this is how I've been operating. This is it. The burden of proof is on you now. You got to prove this stuff. Right?
And they can
That's
never do that.
where we at. What's up, Ja?
Yeah, what up, bro? Yeah, I came in kind of late, but I caught like all what you were saying about like capacity and stuff like that. You know what I'm saying? So I kind of, you know, caught on to that part. But I'm trying to understand my little situation. Like I got my business under the trust. I put it under the 2025. So this is gonna be like my first tax year, and all right. So like as a trustee, I'm I'm filing for the business, but I'm not filing personal taxes as far as me was paying myself through the business.
See, now you do have to file personal taxes
Okay.
because you gave it to yourself through the actual business. See, I'm not giving, y'all gotta understand, I'm not paying me nothing. I'm just using it as expenses of the trust. So I don't know. I don't want to receive no money. You don't give me no money. The trust own the money. The trust just spend on me for me continue to do my missionary work. I never made no money. Get what I'm
Okay.
saying?
So I mean, it's kind of like that, but I wasn't like like the trust. I ain't really had the trust because I ain't got no trust bank
But see,
account
you
yet.
keep saying it's kind of
So
like that. It can't be like now. If you
nah,
ain't got no trust bank account and it's in your name, then what you need to do is you got to have documentation showing that the trustee has the power to do something on behalf of the trust within its name to create that bank account. So you just need the
right,
documentation of it. Authority
right.
has
So
to be given. See, authority has to be given for jurisdiction for power to act. So in order for you to be able to act, to be able to take any form of trust funds within that particular account, it needs to be placed in a form of action. So authority has to be given.
so let me tell you like it's not a trust bank account, but I put it as a asset like the LLC like in the schedule A. Like I put the bank account
But it's
under the trust.
still, you're not listening to me. Just because you put it in there, don't
Yeah.
mean you haven't gave any form of instructions or power for a reason for you to not have a bank account with the trust name. Why it's in your name? That's the question they're gonna ask, and they're gonna turn it into a personal liability. So you need to fully express it on what you are actually doing and the authority, where the authority derives from, for you to be able to do that.
Nah, it ain't. The bank account ain't in my name. It's in my business name.
Even so, what I'm saying is, are you saying it's trust fund? So you still have to allocate how the relationship between your business, the money between the business, and your trust still needs to be specified and specifically stated.
Uh,
Yeah, that's got to happen, bro.
so, all right. Okay, I thought that's why I had to get that clarification, man. I appreciate that though, man, because like I don't really like necessarily pay myself like send my the money from my LLC to my personal account. I just use my business credit card and try to write it off. That's what I've been doing for like years. Just use my business credit card for everything that I could use it for, and then I what I'm saying, write it off at the end of the year. But I got into the trust stuff with you last year, so
See why
I'm
it's
just trying to figure.
listen to this. Let me help y'all understand this from this
Yeah.
perspective. So this is declaration of fiduciary nominee capacity, ministerial residence, vehicle, and account use. So we'll just say John H. Doe declare the following in the lawful capacity as the head of a religious government. We'll just say SNRP, primary trustee of the living trust, having been duly appointed to said trusteeship by SNRP pursuant to its ecclesiastical authority and governing instruments. Just gave you capacity. Okay. So SNRP is a religious body and religious state operating under its adopted constitution, internal law, possessing inherent ecclesiastical authority to appoint trustees and administer religious, charitable, education, and missionary affairs. The Supreme Religious Council serves solely as successor trustee for the living trust and shall act only upon incapacity, resignation, or removal of the primary trustee. The Supreme Religious Council exercises no routine administrative authority over the actual living trust. Then we have Jane Doe serves as the secretary for the Supreme Religious Council and acts as an authorized ecclesiastical officer and fiduciary when holding title to assets or executing administrative duties for mission or purpose. So that means Jane Doe here can literally hold things and titles or assets, right? And execute an administrative duty for a purpose, right? So just know that. So that means anytime you see her name or anything that is considered trust asset, it is for that purpose as well, right? So now purpose and intent, clarify fiduciary, nominee, and officer capacity where asset, leases, vehicles, accounts, platform, or contracts appear in the name of a natural person. See what I'm saying? I'm making it known. There's the authority here. It all's right here. So affirm that the beneficial ownership and control are governed by trust authority and ecclesiastical appointment, not merely by nominal title. Align records with actual religious, fiduciary, administrative practice. Support lawful classification of mission-related expenditures under accountable reimbursement framework. So if we specifically spend out of certain accounts, et cetera, and then it just looks like a form of reimbursements, whatever, if we have to come from anything personal. Doesn't matter. So that means that if I got a credit card and I swipe for the trust or whatever the trust has to pay out to reimburse, that's a form of expenses of the trust, etc. And it keeps going. So just know you understand that part. So it says support lawful classification of mission related expenditures and accountable reimbursement framework, prevent mischaracterization of trust or mission asset as personal property or personal income. We killing that.
Are you sharing? Are you sharing this, Eric,
No,
or are
I'm
you
not
just
going to share
reading
this.
it?
So
Okay,
just,
okay, okay.
I'm definitely not going to share this. So just listen. So fiduciary nominee capacity principle is, and the assets accounts. So that title does not determine ownership. So I want you to listen. Asset accounts, leases, vehicles, platforms, or contractual relationships appearing in the name of John H. Doe and Jane H. Doe may be held in fiduciary officer nominee or administrative capacity for trust and missions purposes. So just because you see my name on something or whoever name on something, it does not mean that it belongs to me personally, because I have written documentation that expresses that. See, I kill any presumption. That's what I want to do. No personal beneficial interest, right? So neither declarant claims personal beneficial ownership of any such property solely by reason of name placement where trust records and missions used govern the asset, controlling authority. Beneficial ownership and use are determined by ecclesiastical appointment and authority, trust instrument resolutions, internal ledgers and records, and actual mission-related use. Now you got to understand this is what? Contracts. Number one is the states cannot impair any obligations of contracts. Understand that? So they cannot create any laws. So now we can say the household occupies a 3-bedroom single family home. And it is in the name of Jane H. Doe, John H. Doe. So since that is so, this means that the residence serves as both as what? The family dwelling of a ministerial household and a regular base of religious activity, including teaching, counseling, administration, planning, meeting, communications, record keeping, and instruction in furtherance of missions and religious state. So the household related costs, the trust supports household related costs, utilities, communications related to expenses are paid or reimbursed by the living trust only to the extent authorized, documented, and consistent with the trust mission and purpose. So where expenses contain both residential and mission components, the mission portion is supported by reasonable allocations, method, and contemporaneous records maintained by the trust. So any vehicles held in the name, etc., as well. Same situation. Mission transportation is religious administration, travel integral to ministerial and family life devoted to the mission. So anywhere we go, anything we doing, doesn't matter. It's all involved. Expenses. So that means vehicle payments, any insurance, fuel, maintenance, registration, and related costs are paid or reimbursed by the living trust pursuant to mission authorization and proper record keeping. Mileage and mission use logs are maintained where applicable as well. Accounts, platforms, and administrative limitations. Certain banks, processors, platforms may require a natural person name or SSN for identification purposes. Such requirements do not alter beneficial ownership or fiduciary capacity. So as I was saying, long as I got it stated out here, it's over. So now we got the right. This schedule does not presume personal ownership of funds. We're not owning anything. So when it comes to identification, the function is primary ministerial residence of the Grand Wazir and family. So continuous base of religious interactions, curriculum development, teaching, administration, and mission operations. The residence function as a integrated mission household where separation of work and life is impractical and not reflective or actual religious practice. See, you can't separate my work and my religious mission. You can't separate it. It's all tied into one. That's why I say, are you truly, do your life truly belong to God? And I have definitely been fortunate enough to set it up to where it does. Any and everything about me. All of it. Right? So what are the mission functions that conducted at the residence? Writing and authorship of religious texts, ebooks, instructional materials, development of curriculum and classes, teaching and instructions, live, recorded, preparatory, religious study and doctrinal development, mission planning, administration, coordination, communication, correspondence, record keeping, counseling, guidance, instructional discussion. These activities constitute active religious and educational labor, not incidental use. So now the trust expenditures to the extent they support the mission function described above. So if there was any rent, any leases, any mortgage, electricity, water, gas, other utilities, internet, communication service, require household service supporting mission operations, that's any pots, pans, forks, I don't care what we buy. Maintenance and supplies related to mission use areas. Such expenses may be paid directly from the trust accounts or through accounts held in fiduciary or nominee capacity on behalf of the trust. Are y'all listening?
Yeah, of course.
I just want y'all, like, I'm not telling y'all something that, I'm already doing this. So I want you to understand. I'm already doing it right now. And you can too. So you got to understand, say, all right, so watch this. When it comes down to child education, it could be development of reason, discipline, critical thinking consistent with the mission, participation in structured educational activities, integral to religious household, religious instructions, and supervised education as well. So I don't care what we buy in form of education. Shoot, I could I don't care if we get on there and get Call of Duty. It could be for the tactical thinking and critical thinking of the individual. How fast do
There
they
you go.
think? Y'all think I'm playing? We could get Madden 25 because you got to be on here and you got to be able to what? Recognize offense, be able to plan, be able to to coach. You got to be able to do the whole full organization. And if you go and play certain modes in Maddens, you got to be a what? Full businessman. You the GM, you this and that. That could teach you business. That's education. I don't think y'all hear me.
Agreed.
Eric, what was the name of that document that you said you would present to a bank to open your trust account to show that you have the banking authority? I heard you and another brother talk about it one time.
What are you talking about? So who has the banking authority?
Show that the trustee has the banking
It's just a
authority to
certificate of
open.
trust. That's the only thing you're gonna have to give to them.
Okay.
Yeah, that's it. You don't gotta get nothing extra.
Okay.
But see, even when it comes to household, now watch this. I'm gonna explain this to y'all, and then I'm done with this. So, nourishment and household food. Food and grocery expenditures are classified as trust expenditures to the extent they sustain continuous religious and instructional labor, including if I don't eat, y'all ain't seeing me going live. So, nourishment during writing, teaching, curriculum development, meals consumed while performing instructional preparation or administration, sustain is necessary to maintain physical and mental capacity for mission duties. So, in order for me to sustain myself to continue doing what we're doing, this is what's got to happen. No fixed meal schedules or artificial designations are required. Classification is based on functional necessity, not timing. See? So I don't care if I get up and eat something at 2 o'clock in the morning, I'm hungry. I need to sustain myself to be able to get ready and talk to you guys tomorrow, or sustain myself through prayer, meditation. It could be anything. Again, don't nobody know. They don't know what I'm over here doing. Y'all don't know until I get to expressing and telling you. But I got it written and out in full writing, full classification to understand and understand what we're doing. Now, there's other ways that it ties into In God We Trust Academy, et cetera, because it's a pass-through entity and it does has contracts, et cetera, with the Living Trust and stuff like that as well, too. But it all needs to be expressed. So that way, if they ever come and knock on that door, here you go. Go do what y'all need to do. After that, leave me alone. It's no way around it, man. And that's why I say classification is everything for you guys. So do truly understand classification matters. Capacity matters. Let's fix those things. Right? Any more questions before we get out of here? I'm gonna answer this one dude question right here that was on All right, he says, so in court, can you appear as the trustee and grand tour to find out who is doing business in your name? I would not even take that approach. Never take that approach. What I'm going to do is just ask for. We're gonna go challenge authority. Depends on what court we're in, what type of authority that they're trying to say they have and to hold against you as a living man in your legal capacity. And the contract they have to deal with first is, well, what authority did the Constitution give to the legislature to write a statute that conflicts of interest within your particular rights? And they can't never show it. Since they can't show it, then that's how I would appear. I'm not going to attach to who doing business in the name, et cetera, because what business actually exists if none at all? if so it's just other ways. Like I say, I'm focused on moving in equity for the most part as of now, which is what I'm trying to get you guys to engage and show you guys as well too. So, who else had the question? You done, Ja?
Yeah. I'm gonna hit it back and listen to what you was reading and stuff like that. Get a full understanding, but for the most part, I caught on.
All right. What words make the trust irrevocable? Just that you say that it's an irrevocable trust and that it's also acting and treated as such as well. And that means that once the grantor puts something into that particular trust, it no longer holds any control or interest into it as all. As far as a full outright ownership to control it. That's it.
Yeah, I got an irrevocable trust. It's an irrevocable trust.
All right.
All right.
All right. Well, guys, hope you guys learned something today. If you had to literally rate today's class, what would you rate it?
Yeah, 10 out of 10, fam.
Beyond infinity.
Sure, it was great. I'm late, but I'm gonna rewatch.
Yeah, I'm gonna leave it up. I'm gonna leave it up for y'all for 24 hours. So it'll still be up for 24 hours, YouTube, wherever you watching, except for TikTok. TikTok, y'all go to YouTube and God We Trust Academy. Y'all can watch it there or follow me on Facebook. Somebody said, so if I wanted to correct my status and start today, what would be the first step? Read the Constitution and start understanding the law. The more you know the law and the application of the law, you correct your status just from that point, because the status happens in your mind, who you are. The question is, are you a resident of the state? How many people in here are a resident of the, not the state, but a city? Yeah. How can you be a resident of the city? You can't live within the city because the city lives within the state. You live in the state and remain as the people. The city will never have power over you unless you give it. As soon as you let them declare you as a resident, what? That means they finna deal with you under statutory relations only. And they're going to operate a bench trial on you because residents, well, that's what you have. You are saying that you are subjected to the ordinance and codes of that municipal. And they have the power to hold these particular proceedings and forum against you unless you object. Same way they have the right to apply certain taxations, et cetera, against you until you object. And remember, they only applying it against you based upon how you volunteered to perform and classify. So I do want to state that. I enjoyed this first one to you guys today. Wednesday, we're going to finish up the actual ebook as well. And we'll be going from there. I'm going to put the ebook up early anyway. So I'll be getting it up today for those of you that are interested. And it's also recorded as well, too. So appreciate y'all. Don't forget about our bingo night Friday. Every Friday night is bingo night. All right. If you want to be able to participate in that, do hit us up so we can make sure you get in those. We're doing this every Monday and Wednesday, except for the fourth Wednesday, which is when the Lawman series is taking place. This is the Lawman Master Merchant Tax Series. So there is a difference, etc. But the fourth Wednesday is special. February the 6th is when the Lawman series drops. So it'll be 10 volumes. You'll be able to get every last one of those that will be available. That's for the do-it-yourself class of people. Now, those of you that want to do like what we did today, sit down, go over the ebook, read through everything, the whole instructional and premium service of that, then that class will be held on the 4th of every Wednesday. If you want to participate, it's $125 for those classes on the 4th Wednesday. If not, buy the whole entire book, read them yourself, or you can go get Only God Can Judge Me. That still exists for you guys today. Go and get that. All right. It's available. It's great. It is really about what everything that we've just been talking about, it all put into one book. Of course, these other volumes are broken down in more detail and more in depth to explain. But again, it's there. It's there for you to take and go further your research. All right. I appreciate you guys. Can't wait to see you guys Wednesday. Peace, love, and law. Y'all have a great day.